The mainstream financial media is running a massive calculated illusion, and almost every retail investor is falling directly into the trap. For the past 6 years, one company systematically engineered the most aggressive, unconventional corporate treasury strategy in human history, climbing from an enterprise value of $600 million to over $80 billion. And yet, if you open any mainstream financial publication right now, the headlines tell you the strategy has completely collapsed. They want you to look at short-term volatility. They want you focused on paper losses. Because if you understand the actual mathematical mechanism behind what is happening behind the scenes, you realize the legacy system is terrified of what happens next. Listen to how Michael Saylor exposes the massive blind spot the elite refuse to talk about.
3 weeks ago, right, Bitcoin traded from 82,000 to 62,000. So we have a $16 billion mark-to-market loss. And so the story is, Saylor's company lost $16 billion. They basically revived me, put me back in charge of the company, and then made me responsible for the failed strategy, which I thought was amusing. But nobody, so if you have 800,000 Bitcoin and it trades down 20,000, you'll have a $16 billion mark-to-market loss. But nobody ever once asked the question, where'd they get the $16 billion to lose?
Think about the sheer weight of that statement. How does a business start with a modest $250 million in cash and wind up with enough pristine digital property to experience a $16 billion drop and still be standing stronger than ever? The answer is an insider game the media simply refuses to write about. They call it a failure when the price drops, but they completely ignore the structural engine beneath the hood. Look at the actual data from this month, June 2026. While the financial headlines were screaming about market weakness, an official SEC Form 8K filing revealed that Strategy quietly went out and purchased an additional 1,587 Bitcoins for approximately $100 million, executed at an average price of $63,000 per coin. At the exact same time, their total corporate treasury stack crossed an unprecedented 846,000 Bitcoins, valued at over $64 billion in aggregate cost basis. But here is the real kicker. While the public was being fed panic, Strategy simultaneously rebuilt its physical cash reserve to $1.1 billion. The media uses volatility as a weapon to manufacture fear. They want you to believe that an asset class is failing because it experiences a temporary retracement, but they intentionally omit the fact that institutional balance sheets are systematically locking up the float, using the very panic they create to average down.
So Bitcoin was 120,000 8 months ago. It's 60,000 now. It's more compelling now. Like it's sitting around the 200-week moving average now. So there's a massive base of support right now, which means that it makes a lot more sense for a risk-averse investor or any diversified investor that has a portion of their portfolio in gold, equity, real estate, credit, and Bitcoin. It makes more sense for them to be moving their allocation back into Bitcoin now. And so you'll see a reversal in the market.
What Saylor is referencing here is the ultimate secret weapon of long-term capital allocators, the 200-day moving average, and more importantly, the 200-week moving average. To the average retail speculator, a drop from an all-time high of $120,000 down to the $60,000 range looks like a liquidation event. But to institutional desks, this isn't a crash. It is a textbook mean reversion. Think of the 200-week moving average as the fundamental book value of the entire Bitcoin network. It represents the exact baseline cost of all the capital that has ever been permanently locked into the asset since its inception. Historically, whenever the spot price compresses down to this moving average, it acts like psychological concrete. And the macro data backing this up right now is staggering. Market analysis reports from major digital liquidity providers like Wintermute confirm that this entire leg down to 60,000 was a massive bear market fakeout, a structural flush designed to completely clear out over-leveraged long and short retail positions. At the same time, the broader macro environment is shifting. The latest consumer price index numbers just printed softer than expected, signaling that the Federal Reserve's restrictive monetary tightening cycle is rapidly losing its narrative power. When inflation fears cool and geopolitical tensions stabilize, liquidity does not simply vanish. It seeks the most efficient, asymmetric escape hatch on Earth. By driving the price down to its long-term moving averages, institutions create a self-stabilizing floor. They strip the asset from weak hands and prepare the canvas for the next massive capital rotation.
Like it or not, for better or for worse, 99.9% of the capital in the world is not invested in Bitcoin and is not invested in the Bitcoin derivatives, the equity and the credit. So if Bitcoin trades down, it just makes the equity, the credit, and the commodity that much more compelling. You'll have capital drawn in that will support it back up. And then, you'll have extraordinary amount of wealth created in the next bull run. And if you look at the last 5 years, if you look at the percentage of Bitcoin versus the other crypto tokens, not including stablecoin, Bitcoin dominance has gone from 40% all the way up to about 68 to 70%. So nature is healing. Bitcoin has emerged as the dominant crypto capital, really the only crypto capital network, the crypto monetary network, right? No one seriously thinks that Ethereum is going to flip. The flippening did not come, right? There is no Ethereum flippening. No one thinks Solana, Ethereum, Sui, BNB, Ripple, any of the other tokens. No one thinks any of them are going to supplant Bitcoin.
Nature is healing. For years, retail investors were distracted by the casino of alternative crypto assets, chasing the illusion of decentralized networks, smart contract platforms, and the highly publicized flippening that mainstream analysts promised would unseat Bitcoin. But a monopoly is a brutal, unforgiving thing. Over a 5-year horizon, Bitcoin's dominance didn't just maintain its position, it cannibalized the entire space, surging from a cyclical low of 40% straight back to the 70% mark. The market has spoken, and it has issued a definitive verdict. There is no second best. This is where the high-stakes reality becomes urgent for anyone trying to preserve wealth. 99.9% of global capital is still trapped inside the legacy banking, real estate, and sovereign debt markets. But sovereign debt is systematically melting under the weight of global debasement. If even a fraction of that global capital pool, just 10%, realizes that it needs an immutable, undilutable digital network to survive, that implies an ultimate target of $100 trillion flowing into a single, hard-capped asset class. If you are holding your wealth in speculative altcoins, traditional fiat instruments, or overvalued equities, you are standing on a shoreline watching the tide pull back before a tsunami. The institutional architecture has spent 17 years and hundreds of billions of dollars constructing the primary digital monetary network. They are not going to build a second one.
It's like Amazon went from $100 to $2 at one point, right? And then it became a fucking $2-3 trillion company.
It was clear in 2010 that there was no retailer in the world that could compete with Amazon.
Yeah.
It was clear. But it was only clear in 2020 that everybody needed Amazon.
Yeah.
So a decade before, the conventional wisdom or the consensus was the world needs a company like Amazon, it was obvious to an independent thinker.
Yeah.
And the same is true with Bitcoin. It's obvious the world needs digital money and digital capital. And is it 10 years before everybody agrees with you? Likely. But as I say, you don't want people to agree with you. You want them not to agree with you. You just want to be right.
Think back to the year 2010. If you told the average person on the street that a volatile, unprofitable online bookstore would eventually centralize global retail trade, they would have laughed. They would have pointed to the conventional wisdom of the time. They would have told you it was a bubble, because human beings are wired to only recognize a revolution after it has already become conventional wisdom. Right now, an independent thinker can look at the math, look at global monetary debasement, and see that the world structurally requires a pristine layer of digital capitalism. 10 years from now, the consensus will agree. It will be obvious. But by then, the opportunity to front-run the largest wealth transfer in human history will be entirely gone. You don't need the headlines to validate you. You don't need the crowd to agree with your thesis. As Saylor noted, you just have to be right. Stay safe out there, and I'll see you in the next video.